Hello. Today we're going to talk about making capital investment decisions. Now, the key concepts here, we're going to understand how to determine the relevant cash flows for a proposed statement. We'll analyze a projected or project's projected cash flows, and we'll evaluate an estimated NPV. And what I want to say about this particular chapter is, as a follow-up to the last lecture, this is good, because in the very last part, probably not as much as I would like, but in the very last part, we're gonna talk about some of the additional factors that go into evaluating capital projects. So, the first category, I guess, is relevant cash flows. What is a relevant cash flow? And so basically what we're talking about here is sunk costs. No. And a sunk cost is where you've spent money, and no matter what you do, you're not going to get that money back. Right? And I can't tell you how many times I've seen people say, oh my God, we spent $500,000 on this project already. We need to keep going. I was like, you spent the $500,000. Can we get that money back if we keep going? Well, the fact of the matter may be no. Or if we cannot, then it's just a sunk cost. It's there, and there's nothing else that we can do. And as hard as it is, as a human being, to ignore that, that's money that's gone. Opportunity costs, we can use side effects and erosion, net working capital. Financing costs, no, because that's already built into the analysis of the net present value. And then tax effects, well, certainly we can get that. So relevant cash flows include only the cash flows that'll occur if the project is accepted. And they're incremental. So this isn't stuff that's happened in the past. It's new cash flows that are going to happen, and only if the project is accepted and we engage in that project. The standalone principle allows us to analyze each project as a standalone entity. So if we do this project, what will happen? And that's an important one, a very important one. So I talked about sunk costs. Opportunity costs represent the benefits that an individual, an investor, or a business misses out on when choosing one alternative to another. So while financial reports, do not show opportunity costs, business owners can use it to make educated decisions when they have multiple options before them. So I can do this project or I can do that project. Which one is the better to do? I have opportunities in both. And if I do project A, I'm giving up the opportunity for project B. And obviously, the opportunity that's presented by project A should be better or bigger than the opportunity that's in project B. Right? Because by definition they're unseen, opportunity costs can be easily overlooked if one isn't careful. So, what benefits might I get might not necessarily be just financial. Maybe there's strategic benefits and so forth, developmental benefits that I can get out of this. So financial costs, financing costs are reflected in the required rate of return, so we don't need to put those in there. And then tax effects, I think everybody knows what taxes are. And yeah, there can be tax effects. So if my project, for instance, involves the buying of a large amount of equipment that's going to be depreciated, that's going to have an effect, a tax shield effect in future years. Immediate, there'll be cash flowing out, but in future years, I'm going to get cash flow coming in because I'm not going to have to pay the taxes for those expenses. So relevant cash flows, right? Corporate cash flow with the project minus corporate cash flow without the project. Simple as that. Again, it always boils down to, if I do the project, this will happen. If I don't do the project, that won't happen. That's the number one rule, and it really is the number one rule. You have to look at it as a unique event, the project being a unique event. Financial analysts sometimes refer to or prefer to look at cash flow metrics because they strip away some of the accounting. So cash flow is a big deal. You know, I know probably when you're in accounting courses, the cash flow statement tends, I mean, you know, you go over it, but everybody, you know, looks at the income statement and the balance sheet. And this is where the cash flow statement comes in very importantly. Because it's okay, how much money is coming in and out? And again, related to if I do the project or I don't do the project. So that's an important thing, and that's basically what we're going to look for when we look at operating cash flow. So pro forma financial statements project future operations, and we'll see in the spreadsheet, we'll see some pro forma. Pro forma means, you know, sort of what if. Operating cash flow, two different definitions of it. We can take EBIT plus depreciation minus taxes. So basically we're taking the taxes out of the EBIT. And then for, we can do net income plus depreciation if there's no interest expense, which is, in both cases, we're just modifying EBIT a little bit. And then we can have cash flow from assets, which is the operating cash flow minus net capital spending, minus the delta, or the change, in net working capital. It's an important point, by the way. Whenever you see the triangle, right, don't call it a triangle. That's the delta. It's the Greek letter for delta, and it means the difference, right? So you know, just kind of keep that in mind. When you see that in a financial or a business kind of way, it always means the change. You know, don't call it the delta. Don't call it the triangle. So what are we going to do? We're going to take a look at the Shark Attractant project. The Shark Attractant project. A little bit crazy, but and here's some numbers that the author has given to us. So let me skip over, and I want to do this in a spreadsheet for you. So here we are with a spreadsheet that shows the numbers that the author has given us for the Shark Attractant project. And so we have 50,000 units or cans of this is the estimated sales. Sales price per can is $4, cost per can $2.50, so forth and so on. Now you notice that this very first one, this is a good example of, you know, the marketing department needs to chip in on this. Okay, if we have this product at a certain price, how much are we going to be able to sell? Now that's an estimate. It's always an estimate. We don't know for sure exactly how much it's going to be. We certainly hope that our marketing department is good enough to actually, you know, get close. But projects do have that certain element of uncertainty, and you got to get used to it, and also make sure that one department is working with other departments and so forth and so on. We have things like tax rate. This tax rate is larger than it would be in today's, but you know, just take it as a number. It's not a big deal. And then the cost of capital. The cost of capital, I guess I would have gotten weighted average cost of capital. That's my discount rate for present value analysis. And I would have gotten that, say, from the chief financial officer. So this pro forma income statement, we say on period 1, so right now, well, there is nothing. I'm not getting anything from this because I don't have it. At the end of period 1, I should, if I have sales of 50,000 units and $4 per, I should have sales of $200,000. So basically we're taking these numbers up here in the raw data field, I guess you'd call it, the assumptions field, and we're turning it into something that an accountant would be comfortable for. Now there's a couple reasons for that. We want to massage numbers into usable right? Nobody actually said it was going to be $200,000, so we'll massage that into that usable number because we're going to use it in just a second. And then, secondly, by putting it into this format, and it doesn't have to be exactly like this, but by putting it into this format, we're making it much easier to read. So we'll go to sheet 2 on my little spreadsheet here, and this will show us a cash flow statement now. This cash flow statement is taking the same numbers that we took from, that we came up with on this previous page, and it's putting them into, okay, what are the differential cash flows on this project? And operating cash flow, right? Operating cash flow, in this case, what we're going to do is take sheet 20 minus plus 19 minus 21, sheet, C20, yeah, right. So C20, which is our EBIT minus the depreciation, and, plus the depreciation, minus 21, which is taxes. So those three numbers that, you just saw them on a slide, a PowerPoint slide, a heck of a lot easier when we do this pro forma, that, okay, as a business person, this is what I'm used to, and this is what I can pick up on. Another reason, by the way, or another thing that I did was I put these on two different sheets within an Excel spreadsheet workbook, just to show that we can refer to from one sheet to another. It makes it a three-dimensional sheet. Let me go ahead and change it to the formulas, so you can see here it says sheet 1 exclamation point C. It's actually C20 plus sheet 2, sheet 2, and so forth and so on. You can see it way up in the corner here in the formula bar. The point being is that you can, because you can now make, and for a long time, you can make a three-dimensional spreadsheet. It's let me turn this back. It's easier for you to do your workup on one sheet, and then, okay, this is how I'm going to use those numbers on another sheet. For one thing, it allows somebody to just concentrate on this. Actually, that's the big thing. It allows somebody just to concentrate on this particular sheet. So we've got operating cash flows. We've got changes in net working capital. Net working capital changes would be sheet 1. I got B8, which is B8. Yeah, is $20,000. So that's the investment. That's the change. That's the only change that's going to happen in the networking. I'm going to not have that money, right? And in this case, we just multiply it by a -1 to come up with a negative. The net capital spending in this case is B6. So I have the initial equipment cost. So again, if I do this project, I'm going to be shelling out $90,000. And then we've got cash flow from assets. Well, the cash flow from assets is this $20,000 and the $90,000. So basically, from my assets, if I were doing a balance sheet, I could expect to see $110,000 come off of the asset side of the balance sheet. Right? No, where's it? Well, not come off. Excuse me. It's going to come out of probably cash and go into equipment. And so down the bottom, each one of these on this particular row, each one of these represents, for the period, it represents the differential cash flow. We do a net present value on that differential cash flow. And that net present value, basically, the net present value is the analysis is the net present value of these three, period 1, period 2, and period 3. And then we're going to take and we're going to add back in that $110,000 that happened on the first year. And why do we do that? Well, we're going to do that because we're going to do that because if we did a net present value on the entire stream, that would show the net present value as being less, basically, less than what it actually is, because this $110,000 happens immediately. It already is at net present value. So if I discount it further, it's going to skew the analysis. The other thing that I love to always see is the internal rate of return. So I know that this project has a positive net present value, and I know that it has an internal rate of return. Now, to be perfectly honest with you, it's a 3-year project. I probably wouldn't do a break-even analysis unless somebody asked me for it, but that's another one that's valid. You know, how quickly is it going to be before I get my money back? Within a 3-year period, it's probably not that big a deal. And so here's my the OFC, or the operating cash flow, EBIT plus depreciation minus taxes, and you can see we have the numbers. 51,000, which is the operating cash flow, is gained by the $33,000, which is my depreciation. Right? You don't see that up here, but it's on the previous page. Depreciation. Nope, that's my EBIT. Depreciation, $30,000. Oh, I'm sorry, EBIT and then depreciation. I guess you could put them in any order. And then taxes being 11,220. And that's just a function of the tax rate. So, with just those two sheets, we've taken a quick look at the facts that have been presented to us for this particular project. And we've taken the facts from raw data, if you will, the state. I mean, this stuff up in here, right? This all could have been written down on a napkin for all I know. And then we've formalized that information a little bit in the pro formas. And then we go over here and we actually do our cash flow analysis. And that, my friends, is really, when it comes to the financial part, that's really what the justification looks like. Not an awful lot. You think, oh my God. And I'm talking about millions of dollars of projects here. So this is a very, very, very valuable tool. Net present value, internal rate of return. You really want to get to know those. Now, the other day, or the other lecture, we did talk about the modified internal rate of return, where, for instance, if I had to decommission something, and in the last period, we'll take, for instance, the sign changes. So instead of a positive cash flow, it would be a negative cash flow. You could modify that for that. You get some explaining to do if you do it. It makes it a little bit more complicated. But we'll say if this was a negative 71,000 instead of the positive 71,000, what I might do is I might zero that negative out, take the present value of that negative 71,000, and then add it into the 110. That would be a modified internal rate of return. It's legitimate. You're not doing anything funky with it. But again, it's some additional explanation that you might have to do. You probably projects where that kind of thing might happen would be, you're probably not going to be doing this tomorrow, but if you were doing a project for a nuclear power plant, well, at the end of the lifespan of the nuclear power plant, they have to do something with that nuclear waste. That costs a lot of money, so there's a negative cash flow at the end. If you were doing a mining project, which actually my company did a mining project in Ghana, at the end, you need to clean that up, right? Environmental concerns and things like that. So there's absolutely occasions where you will get those negative cash flows. It doesn't happen necessarily all that often, but it can happen. You should be prepared for it. Here's the deal with net present value estimates. Those can be, here's a scenario analysis we're going to talk about in a second, and here's some assumptions that have been made, and they're assumptions. And so net present value can in fact be somewhat of a, kind of a tricky game. Now we can do a sensitivity analysis, which is what this particular chart says. Is we're going to put together assumptions that are good for our, let's see, over on the left it's base, and then worst case, and then best case. And we'll put those together, and we'll see, well, and what is the worst case, what is the best case, what can we probably expect. We could also even put some estimates of, base will happen 90% of the time, worst case 5% of the time, so forth and so on. And that gives us an idea, right? But it's very, very limited. It's very limited. It's like, well, who says that is the best case, and so forth and so on. So one of the things that we can do is we could take this same information and we could change something. So we'll take the base, right? That's what we expect to happen. So we'll start with our base. That's our base case. And we'll say that the units that we're going to sell, the 50,000 units, or 5,000 units here, well, what happens if it's 4,000? What happens if it's 3? What happens if it's 2? What happens? And then we can calculate a net present value for that. And then what we can do is we can do it for all of our different estimates. And if it's not an absolute positively, this is what it's going to cost us. Like, for instance, the equipment purchase, right? That's what it is. That's going to have. So we don't have to worry about that. But everything else that has a variable in it, we'll change it to what that variable could range to. And then what we'll do is we'll put it through the same kind of analysis where we change more than one of those factors. Now this is what's called a Monte Carlo simulation. In the statistics point of view, it's known as a regression analysis. And so what we're trying to solve for is the net present value in each case. That's what we're trying to solve for. We get the net present value, and then we have all of these, what we would call independent factors. Right? And so sales is one of them, and so forth and so on. And we're going to change these and crunch them in different iterations, and that's going to, each time, it'll give us a different net present value. We assume that it will. And then what we're going to do is we're going to take all of those different net present values, and we're going to chart those out. And lo and behold, most likely what will happen is that we'll come up with a net with a normal distribution. And then from the normal distribution, we can take, one standard deviation on one side, one standard deviation on the other side. That's our base case. And at 64% of the time, pretty cool that's going to happen. All right? Or we can do 2 standard deviations out. Yeah. What happens if it's 2 standard deviations? Oh, it's still acceptable. Okay, that can be our best case. 2 standard deviations is 95% of the time. What if 3 standard deviations, we're still, in our worst case, we're still good with it? Oh, that's 99% of the time. This looks like a good project. And if it happens that we get the average, well, we know what our estimated net present value is. Again, it's called a Monte Carlo. It's very extensive. You do it with software. You don't sit down and do it on a hard copy piece of paper or spreadsheet, because it's very, very complicated. We're talking about tens of thousands of iterations. And this is truly what happens. I've got a friend, he was thinking of opening up a dispensary, weed dispensary, in Salem, Massachusetts. And we were sitting down, the club, having a beer, and he told me all about how he brought in these consultants and they were doing a Monte Carlo simulations. And they did exactly that. They took what were his assumptions, and they said, okay, if it changes. And they put it through the software, tens of thousands of iterations. And it's, okay, here's what you can expect to happen on average. Here's what you can expect to happen on the best case, and here's what you can expect to happen on the worst case. Now, it probably didn't consider something like, the COVID-19 pandemic that we're going through now, where everything's closed. But under normal business operating, with normal kinds of interruptions, that's probably what you could expect. And this is done all the time. All the time. This is what you hire a good consultant to come in and do. All right, so a couple other things. One is, and this is probably the best part of the chapter for me, is that you have managerial options. You have the part where you can put in that human aspect into the decision making of the project. So things like contingency planning. Well, what happens if the worst case does come true? Do we have a contingency? Can we work around that? Can we overcome that sort of thing? Do we have alternative options to expand with existing product lines, new products, so forth and so on? Do we have an option to expand? If we engage in this project, will it give us further options? In other words, might we? It's not part of the project, but might we be able to expand the product lines and so forth and so on, which makes it even more attractive. We might have the adoption to abandon. Now, every good project manager will tell you that you don't just put work steps in a project. You also put what's called milestones. And those milestones are there as major events, and they're decision-making points in a project. And also, project managers will tell you that it is a hell of a lot cheaper to stop a project in the beginning than it is at the end, right? Because you haven't put as many resources in there. And part of the project manager's job is to actually bring that up. Make sure that people say, okay, should we stop this project? Now, you have to make a decision before you even start it. Are we in a situation where we can abandon a project? Is that going to be a possibility? Could we contract it? Could we skinny the project down if we needed to? Could we just temporarily suspend it if we needed to, if something happened? This is contingency planning. Do we have the option to wait? Is always an important. Can we? If we do it, do we have to do it now? Do we have to do it now to get this benefit? If I don't have to do it now, hey, time value of money, right? I can put money into a different project, get that done, and then a year from now, can I revisit this and do it and still get the same benefit? Well, maybe that's what I'll do. And then the strategic options. Strategic options, as in, does this project lead to something that is going to support the strategic direction of the company, the overall strategic direction? Very, very important. And that's a managerial decision-making process. Now, capital rationing is something that kind of naturally always happens. I mean, let's say we're talking about a portfolio, a management portfolio or project portfolio of, say, $30 million. And, you go to managers, right? And if managers are good, they'll come up with $40 million worth of projects. They never leave money on the table. I mean, that's their job, is to take capital and use it effectively and efficiently so that we can multiply our capital. That's what they're all about. Leaving it on the table is contrary to that. So, we have limited capital resources for whatever reason. Either the business isn't doing all that well, or there's just so much we can. Maybe there's just so much we can handle. All right. And so you might want to ration. Now, in where I come from, we used to have 3 strata of projects. We had imperatives. And an imperative is something that I have to do. We'll say maybe the government passed a law, regulation, so that sort of thing, and I need to engage in a project so that I can comply with that. I have to do that. That goes to the top. And then there are those projects that are very profitable, great strategic fit, very overall to the corporation, they look like good deals, right? That's the middle strata. And then there's the nice-to-haves. Now, the nice-to-haves are really what we're talking about with capital rationing. Capital rationing, that's where it's like, well, this would be nice to have. We don't need to have it, but that would be nice to have. And yeah, it's got a positive net present value. But geez, I got all those ones in the middle strata that I really, really got to get to. So what do? We ration that capital. And one way to do it, in a pretty effective way, is that when you do the net present value analysis, if it's this is really going to fit into the strategy and so forth of the company, you might give it, if your weighted average cost of capital is 10%, you might give it a discount rate of 10%. If it's a nice to have, you might give it a discount rate of 20%. Make it harder. Make it harder for that project to jump the hurdle of net present value. And then the numbers start to speak for themselves. Now everybody's got to know that that's what you're doing, and certainly I agree with it, because somebody's nice to have is somebody else's, oh, I really want this. So you have to be careful with that. But it's a reality. It's a reality, and it's part of that management intervention, that massaging, that human part of decision-making process that's absolutely present in every corporation. So that's the lecture for today. Thank you for watching. I hope you enjoyed it.